Good evening. I'll be reporting on the tax treatment on pension, separation pay, income from any other source, and gross income exclusions. So let's start. This will be the flow of our discussion. We'll start with pension, retirement benefits, and separation pay, income from any sources, and the exclusions. Pension. What is a pension? Usually, the pension is an amount of money given in lump sum or staggered basis, and this is given for as a consideration for an individual services, and this individual has reached the age of retirement. So this is usually common in police officials who has retired or government employees who has retired. They will receive pensions from GSIS and the like. So, what would be the tax treatment on pensions? As a general rule, pensions are subject to tax to the extent of the amount received. However, if this pension is part of an BIR approved pension plan, then it is excluded or exempted from to be part of the gross income of the taxpayer for tax purposes. So it is also important to take note of Section 32, Paragraph B of the National Internal Revenue Code, which provides that those who receive pension under RA 7641 shall not be included. The pensions received under this law shall not be included in the taxpayer's gross income and shall be exempt from taxation provided that the following are present. First is that these pension or benefits are received in accordance with a reasonable private benefit plan maintained by the employer. Second is that the retiring official or employee has been in the service of the same employer for at least 10 years and is not less than 50 years of age at the time of his retirement. But take note, what would prevail is what the minimum age and the year of service required by the private benefit plan. So, thus, even if the employee has rendered at least 10 years of service and is not less than 50 years of age, but then uh, the minimum requirement of the private benefit plan is higher, then the pension that he receives will not be uh, exempted from taxation. So the next requirement is that it must be availed by the official or employee once. So next is we have the separation pay. So usually this is a common trend, especially in this time where the effects of COVID-19 has led to the closure of many businesses or the retrenchment of its employees to save the business. So what is a separation pay? So a separation pay, this is an amount that is given to an official or an employee or his heirs from the employer as a consequence of separation of said employee caused by death, sickness, or physical disability, or any cause beyond the control of said employee. So, what would be the tax treatment? It depends on whether the separation was the cause of which was involuntary or voluntary. When the cause of the tax separation was involuntary, like for example a retrenchment due to unfavorable business condition, the separation pay received by the employee is not would not constitute would be excluded or and would not constitute as part of his gross income for tax purposes. However, when the separation was voluntary, as where the employee voluntarily resigned and he received his separation pay, that would constitute as part of the taxpayer's gross income for tax purposes. So next we'll proceed to income from any sources. So what does this any mean? So these are income which are not expressly exempted within the class of taxable income under a law. So this income could be a result of the taxpayer's voluntary action, or it could be gained involuntarily. And this regardless of whether this the source of income is from an legal or illegal activity, this will be subject to tax. This would be constituted as part of his gross income for tax purposes. So wait. So an example of income from any source which forms as a part of taxable income. So an example of those income gained from an involuntary action of the taxpayer is as a result of an involuntary action, or gains arising from expropriation of property, which would be considered as income from dealings in property. So, as where the government or the local government has exercised its power to take private property with just compensation for public purpose, then the proceeds received by the taxpayer would be part of, of his gross income for tax purposes. And the and another example of income derived from illegal source, which would also be constituted as part of the taxpayer's gross income for tax purposes, are gains or money or otherwise derived from extortion, illegal gambling, bribery, graft and corruption, kidnapping, and racketeering. So next. So it is also another source of income from any other source is the condonation of debt. So the tax treatment for condonation of debt would depend on the purpose or the manner of the condonation. So when the condonation was made in consideration of the services of the debtor, then the the there would be a taxable income uh, to the extent of the amount of debt condoned. And next, when the creditor merely wants to debtor to benefit and there is no consideration for the condonation, then the condonation would be treated as a gift and it will be excluded to his gross income for uh, tax purposes. And next is when the corporation condones the debt of its stockholders, this would be treated as an indirect dividend, and hence it would be constituted as part of the taxpayer's gross income for tax purposes. So recovery of accounts previously written off, or also known as bad debts. So this would constitute as income from any other source, and it really and so the definition of a bad debt is that these are debts resulting to unworthiness or uncollectibility in whole or in part due to the taxpayers from others. So this bad debt could be an example of this bad debt is where a business has sold its goods on credit and the debtor has failed to pay for a long time or for an unreasonable time, and that account would become a bad debt, and the business will write off such debt, and it will be deducted to the gross income. Now, what if the bad debt will be recovered by the taxpayer on the succeeding year? So the tax treatment uh, depends on whether at that year, at the time when the debt was written off, the business was operating at a gain or at a net loss. When the taxpayer has operated at the gain, the tax benefit rule applies. And under the said rule, the recovered bad debt shall be included as part of the taxpayer's gross income to the extent of the income tax benefit of said deduction. This uh, this will be included in the at the time where when the bad debt was recovered. So what if the suppose if the however the situation would be different if the bad debt was written off at the time at the year where the business of the taxpayer was operating at a net loss. So if the taxpayer recovers it in a succeeding year or next year, uh, then the recovery of the said bad debt will be treated as a mere return of capital. So, for example, supposing that in year 2019, ABC Corp had a net taxable income of 1 million, and during that year, a debt arising from uh, and during that year, a bad debt arising from uncollectible amounts for goods sold at credit was written off. The said bad debt was recovered in year 2020. Will the receipt thereof constitute as taxable income? Yes, it will constitute as a result as part of taxable income since during the year the deduction was made, the business was operating at a gain. If the said bad debt could have been collected at year 2019, it would have resulted in a higher gross income. Now, supposing that in that said year, ABC Corp or operated at a net loss, will the receipt thereof constitute as taxable income? No, it will be treated as a mere return of capital since during the year that the deduction was made, ABC Corp was operating at a net loss. So another kind of income from any source is the receipt of tax refunds on credit. So as a rule, a receipt of tax refunds or tax credit certificate results in the realization of taxable income which must be included in the recipient's income tax return in the year it was received when the refund was for erroneously paid tax which was claimed as a deduction from his gross income and that the deduction would lead to a lower taxable income or higher operating loss, which will be carried in the succeeding taxable year. So, tax refund on the following taxes. So, there is an exception on the taxability of tax refunds. Tax refund on the following taxes does not result to taxable income since these are not deductible from gross income. So, these are the following: income tax, estate tax, donors tax, and special assessments. So let's proceed to the next topic on exclusions. So what are exclusions? Exclusions are income received and earned, but is not taxable as income since it is exempted by law or by treaty. So how will these exclusions be construed? It shall be strictly construed against the taxpayer and liberally in favor of the government. Since exclusions would not result to a revenue in favor of the government, this must be strictly construed. So, what are the bases of exclusion? So, there are different bases as to exclusions. So, here are so it could be that the exclusion was made since it was not an income, gain, or profit. A good example of this are, is the receipt of life insurance proceeds paid to the beneficiaries. So these life insurance proceeds paid to beneficiaries is a uh, would constitute as an indemnification for the loss of, let's say, the life of the said person insured. So, since a contract of indemnity does not contemplate any gain, so it does the proceeds thereof is not subject or is excluded from gross income. So, next reason is that it represents mere return of capital. An example of this is when the return of premiums to the insured. Third reason is that it could be the said income could be subject to another kind of internal revenue tax. So gifts and bequests are subject to donor's tax. And finally, another basis of exclusion is that such income, gain, or profit is expressly exempted from income tax under the 1987 Constitution, tax treaty, NIRC, or general or special law. Who may avail of the exclusions? So all kinds of taxpayers may avail, regardless if he is a citizen or an alien, or if he is an alien, uh, regardless of whether he is resident or a non-resident alien. So it is also important to distinguish exclusion from tax deduction. So distinction. So as to reference, an exclusion would refer to a flow of wealth not treated as part of gross income since it is exempted by law or does not constitute as income. On the other hand, amounts which the law allows to be deductions are amounts which the law allows to be subtracted in the gross income in order to arrive at net income. As to computation, exclusion pertains to gross income, while on the other hand, deduction pertains to the computation of taxable income. As to its nature, exclusions are income earned and received by taxpayer but does not form as part of gross income, while deductions, these are items which are spent by the taxpayer to earn gross income. A good example of this would be the salaries paid by the taxpayer to its employees. That could be deducted to the taxpayer's gross income. Next distinction is on the an important distinction is on the exclusion versus tax credit. So as to its nature, an exclusion is an amount received as income earned by the taxpayer, but it is not included in its gross income. While on the other hand, a tax credit represents an amount which of tax previously paid, which may be deducted from the taxpayer's present tax liability. So finally, so exclusions under the 1987 Constitution. So under the 1987 Constitution, it is provided that all assets and revenues of non-stock, non-profit educational institutions actually, directly and exclusively used for educational purposes shall be exempt from taxation. So, in order for the revenue of the educational institution to be exempted from taxation, the following must be complied. First is that the institution is non-stock and non-profit, and second, the revenues are actually directly and exclusively used for educational purposes. So, it was held in jurisprudence that regardless of the amount that the school earns uh, from its tuition fees, uh, it shall be exempted from taxation provided that it is a non-stock non-profit and that the said revenues are actually directly and exclusively used for educational purposes. So that ends my discussion and I God bless us all and thank you for listening.